Hi everyone, it's V Spear at the James Beard Foundation coming to you again today with one of our industry support webinars. Today we're going to be talking to the team at Aprio, who is going to be telling us about cash management. We're going to go back through the PPP again, some of the SBA loans that are available to you, this time from a CPA's perspective, hoping to dig in a little bit more to what's changed since yesterday or last week when we did this the first time. So what you heard last week might be a little different than what you hear this week, and we're hoping that we have a couple new solutions for you as well to weigh what may or may not work. As always, we are treating this as a peer-to-peer friendly conversation, as if you just happen to be best friends with three of the best CPAs in the nation, and they're just going to give you some off-the-record type information as to what they know today, what's been working for their clients, what they see as a possibility maybe for you. It's not meant to be the exclusive be all end all of the world. It's meant to be more peer led and not in lieu of a conversation that you need to have with your actual CPA or accountant or lawyer and understanding your specific state, which may be slightly different than what we talk about broadly today. As always, we are updating the jamesbeard.org/relief website 2 or 3 times a day. That's got everything from how you can call your congressman to what updates have come through in stimulus to what's coming up in webinars, things other folks are doing nationally to help cope with the virus situation right now. So you can check us out there. And for those of you who wrote in and were asking about the grant and the fund that we're working on, a different team handles that, but I want to let you know, I know that they're coming out with more information this week. So you should be hearing this week about the first round of grant benefactors and what we'll be doing to continue to try and put money back into the restaurant system and continue to support you in the best ways that we can. So with that said, there's a couple ways that you'll be able to interact with us today. And Emily, although her hair is looking so good today, her Wi-Fi is not working as good. So I'm going to take it today, but this webinar is being recorded. We're going to send out a link of the recording after the program wraps up. We'll save all of the questions for the end, unless your question is something that will clarify a point that the speaker is already making. I'll be monitoring those as we have been for the last couple weeks. So you can go ahead and write your questions in any time in the questions bar that's on the right side of your screen there. If you're having any technical difficulties, or if your question's not coming through, you're getting an error message, you can use the chat function and that'll go to us as the organizer so we can try and help you with that. You can also email us at any time at impact@jamesbeard.org, and that's for clarifying questions if you're having issues with your tech today, if you have something we can help you out with in the future, impact@jamesbeard.org. And so with that, I want to hand it over to our friend Tommy Lee, who's going to introduce you to the team and give you a little perspective on what we're going to be talking about today. Tommy?
Sure, thank you very much. Thanks for having us. It's really nice to be talking to the restaurant community. I lead the retail and hospitality and franchise group here at Aprio. We're an accounting firm based out of Atlanta. So we represent restaurateurs and other hospitality companies really across the country. So we hope to be able to bring you today kind of a perspective of what we're talking about with our clients around the country and our restaurateurs around the country that hopefully will be useful to you. I'm joined today by my partner and colleague, Jessica Hussain, and also my partner, Meredith Kowal. That's going to go, and the three of us are going to go over the tax credits and some of the tax credits that are afforded really to everybody, but that hopefully may be used by some restaurateurs that have kept their employees. The EIDL and PPP loans, we're going to go over those pretty quickly because I think a lot of people have already gotten a lot of information. I know, Sarah, you've already done a couple of webinars on those subjects. So we'll go over those relatively quickly, give you some updates because we are sitting on the front lines of a lot of those loans. And then we're going to go over some of the, kind of give you a little bit of insight to how we're counseling our restaurateurs and how we're thinking about things of how we use these debt facilities, how we use the capital, what capital sources we think are coming, and how we're going to reopen. And a lot of that really just depends on your locale. It depends on your restaurant because I think everybody is in a very different situation depending geographically where they're at. So that's what we hope to present today, and I hope everybody finds it useful.
Great, thank you so much, Tommy. And I know our first presenter is Meredith, who's going to be talking a little bit about some of the tax benefits, sick leave, things like that up front. So Meredith, Tell us a little bit about what you know.
Yeah, absolutely. So before we get into these, we had the stimulus package that came out and, spoke about the SBA loans. And then we had the Families First Act, which actually came out before that new law. And the Families First Act actually, created a lot of different tax incentives that may benefit a lot of the restaurant owners. So we thought it would be good to kind of give a quick overview. A lot of these may apply, they may not apply. One thing to keep in mind is that as we go through these credits, they are not intended to be double dipped. So if you do end up getting the SBA loan assistance and you essentially use that for payroll, you're not able to also claim the credits. But it's great to understand these different credits at a high level, because then if things don't shake out from the SBA side, or if you want to recoup the time you're paying your employees from April 1st up until the time you get the SBA loan, there's still that opportunity. So there's a couple different tax credits we're going to talk about, and these were enacted to be immediate tax credits. So you don't need to wait until you file your return next year. These are credits that will get reported on your next quarterly filing. They're refundable, so they're guaranteed to give you that cash in hand when most of us need it the most. The first one we're going to cover is the sick leave and the family leave tax credit. And these are payroll tax credits when you basically provide your employees with that paid sick leave or paid family leave. And one thing to keep in mind is that if you have over 50 employees, this is something that the government requires you to offer. It's a policy in place that you cannot deny from your employees. So if you have over 50 employees that are still on payroll and they're having to take sick leave or family leave, which we'll go over the definitions behind that and the eligibility, there is a tax credit, and you are eligible to claim up to $12,000 per employee that's taking this leave starting April 1st. So it can definitely add up, especially if you have over that 50 employee count. And we're seeing a lot of the payroll companies and a lot of the PEOs, to the extent you use those, become pretty affluent with these, and it's becoming a pretty easy claim to take advantage of. So the first thing with sick leave is if you are having to, either yourself or your employees are having to take time away from work because of federally mandated quarantine, self-quarantined, or if they are physically experiencing COVID-like symptoms. So if you meet one of those three buckets, when you're taking time away from work that's paid, that would qualify them to, obviously they'd get paid in full, but you could claim a credit up to $511 a day per employee. So these are employees, they're not working, but they're still getting paid. Keep in mind, this does not qualify for employees that have been furloughed or have been, they're unemployed now. These are active employees. Another thing, to the extent you're self-employed, you can also claim this credit for yourself. So that's sick leave. There's a lot of overlap with the family leave, which we'll cover on the next slide. And the main difference between the family leave and the sick leave is the family leave is if you have employees that are having to take time away from the workplace because they're caring for a sick child, or a child that might not be sick, but they're not able to go to school because of these quarantine or self-quarantine mandated restrictions. So if you do have employees that fall under that category, the credit you may claim for their time off is capped at 2/3 of their pay, the lesser of that, or $211 a day. So there's another credit you can also claim in addition to the employees that are taking time for being sick. So this is just one thing to keep in mind. It's not retroactive beyond, prior to April 1st, but if you had employees that were away from the workplace recently, after April 1st, this is one thing to keep in mind. It's a very straightforward computation. If you work closely with your payroll provider or your PEO, just make sure that they're filing this on your quarterly 941. We've looked at all the websites out there, and they all are pretty well versed at this point. So it's a free benefit. We want to make sure you're taking advantage of.
Meredith, just a
Okay.
quick question that we got on that. How, for servers, they get paid $2 an hour and then their tips. What rate should people be figuring is like an average server rate? Should they use like minimum wage, or how do they determine what a server's value is?
Yeah, so it's what they're actually getting paid. I know servers, there's a fine line between the tips received and what's actually reported. And so the intent behind this benefit is to claim the credit for the Social Security taxes withheld. So we look at what they're actually being paid. It can be tips included, assuming they're reporting those tips. And we also look at, are they working full-time or is it part-time? If they were working full-time and now it's part-time, we definitely want to take in that into consideration. But you definitely want to compare that to the minimum wage.
Excellent. And one more time, how would this affect that server's unemployment claim or something like that, or that's completely separate? That's that if a server's off now and they're collecting unemployment, this won't work with that.
That's correct. Yep. If a server is claiming, sometimes, whether it's state or federal unemployment or both, then that makes them ineligible, or the employer is ineligible to claim these credits.
Right. It would only work if like your sous chef were to get sick this week and you were to keep paying them out of your payroll, you'd be able to apply for this credit.
Exactly. Or if you have some servers that are having to stay home with their children,
Okay.
it would apply for them as well.
Great. Thank you.
And then this slide, it's really just a nice summary. It gives a quick overview, and we'll distribute these after of how that sick pay or the family leave really interact with each other. You cannot take the $511 and the $200 credit at the same time. Mm-hmm. However, you can take the $511 credit for 2 weeks, and then you can take that $200 credit per employee for, an additional 10 weeks. So there is a pretty high cap with these that ends up being about $12,000 per employee. So it's, what we're telling our restaurant groups now is just to track it. If you have people going out, keep a spreadsheet, make note of who can't come to work and why, if it's childcare related or if it's, sickness related, because at the end of the day, that's what you would provide to either your CPA or your payroll provider, and they would be able to generate these credits pretty automatically.
Excellent. And we'll be sending this presentation out. So for all you out there who are trying to like frantically scribble this down right now, you will get this presentation to be able to weigh this and read more details later.
Yeah, perfect. So another credit we're going to just touch on briefly is the employee retention credit. So, we have some credits that are intended to incentivize companies that are having to pay the payroll for employees that can't come to work. And this credit, on the flip side, it's intended to incentivize companies that are retaining that talent and, through these tough times. And in order to qualify for these credits, your operations have to either be partially or fully suspended, which all of us are pretty much going through that at this point. And what that's defined as, it's having 50% less revenues than this day last year. So the same quarter in 2019. And again, that's something that we're seeing, it's happening across the board. So if you are in that boat, there is a credit out there, and it is essentially it's capped at $10,000 per employee that you retain throughout this crisis. And the way the credit's computed, it's 50% of their qualified wages. And that ends up being, the $10,000 per employee cap. So, and again, it's just something that's great to keep in mind. It gets filed the same ways as those FMLA credits, whether, it's the sick or the family leave. But again, it's something you just want to work closely with your CPA, your payroll provider, your PEO, because it's a pretty simple calculation. And if you have, 50 plus employees, even if you have less than 50 employees, if you're keeping those employees on payroll, it's a great credit to give you that immediate cash benefit. The one thing to keep in mind with this is there is a fine line between if you have less than 100 or more than 100 employees. And What we look at is if you have less than 100 employees, you can basically take this credit off all of your employees, whether they're working or not. If you have more than 100 employees, then you can only qualify the wages of the people that are unable to work. So it's definitely more beneficial if you have less than 100 employees, but it's still worth pursuing if you have more than 100 employees. This is a tax similar to the other ones, or it's a credit. I mean, it gets applied against your Medicare and your Tier 1 taxes, and again, it gets filed quarterly, so it's refundable. It's not something you have to wait till next year to offset your taxes with. It's intended to give you that cash in your pocket to make it through these hard times.
Great, thank you. This is the first time I am hearing of this credit in all of the webinars that we've done on this so far. So thank you, Meredith, for bringing a new solution forward that maybe will help folks out. And again, this presentation will be sent out, and we'll be going through some of the questions that y'all are sending in more towards the end. One question that I do have, though, is can you take the ERC for wages paid after April 1st, but before you receive funding on your PPP loan?
So if you receive funding on your PPP loan and you use that for payroll of employees that are still with the company, then you're not eligible to take this credit. So they do prevent the double dipping, but at this point we don't know what type of loans we're going to get or what they're going to cover. So it is important to keep in mind, but do document everything because timing is key. Depending when you get the loan, you might be able to take advantage of this until then.
Right. And it may be something that you want to choose over going for that SBA loan if this makes more sense for you.
Absolutely. Absolutely.
Great. Excellent. Thank you, Meredith. Is there anything more on this particular subject to share?
No, this is it.
All right. Well, thank you very much, Meredith. We're going to have Meredith back at the end to answer some more questions on this particular topic. But next, we're going to go back to Tommy, who's going to tell us a little bit about the SBA loans that we've been talking about in the EIDL. Tommy, give it to us one more time. What's the SBA's role in recovery?
So SBA, so the funny thing is I really started this SBA world about 3 weeks ago. We were doing a webinar here in Atlanta for a lot of our restaurateurs, and we were talking about cost containment, revenue preservation, and literally the world is crashing around us. I mean, I think during the webinar, I think the state of Illinois started shutting down restaurants and Ohio started shutting down restaurants. And so we pivoted relatively quickly to find out, hey, where can we, provide some value to our clients? Where can we find some liquidity? And even then, looking back on, I don't think any of us had any idea what was about to happen. But the SBA is, for better or for worse, and I'm not sure which one, time will tell, was the first role, kind of the first government agency that the feds came in to really try to push some money out to small business owners. And they did it, at least as of today, they've done it in three basic ways. The first way that they did it was really the EIDL loans. I should probably reorder these slides. But the first way they did it was the EIDL loans. And that's, and I'll go over that in detail in a second, but this loan's been around for a long time. The same loan that you as a restaurant owner or any business owner would have used if you had something in the path of a hurricane or a tornado or a flood. The SBA would step in and you would get one of these economic disaster loans. And we'll talk about some specifics of the loans and what its state is right now. The second is the Paycheck Protection Program. I'm going to refer to this as the PPP loan because I can't say Paycheck Protection Program that many times. And this is this is a really popular one right this second. This is certainly a good program, but there's some limitations to it, and especially for our restaurateurs, especially in the really affected sphere. We were talking earlier about you guys being in New York, and where it's really hard to tell a restaurant in New York, hey, this is great for the next 8 weeks, but for our restaurateurs in LA and in Denver and Atlanta and surrounding areas, everybody's kind of in a different state where these may be really, really useful and you get the forgiveness provision. So Jessica will go through those in detail, and then we'll talk about some of the strategy on the back end. The last thing, and I really think this hasn't got enough press, but the last thing that the SBA has done is that for anybody that utilized SBA debt, and a lot of restaurateurs do, for anybody that's used SBA debt, the SBA is actually paying the principal and the interest for the next 6 months. So they're not deferring it. They're not saying, hey, we're going to put this on the back of the loan. Here's a deferment. This is not your landlord, right? This is, hey, we're actually stepping in and we are paying the interest and principal on this debt for you. So I think that's not gotten enough press, but that's a big deal for the restaurateurs that have utilized SBA or currently utilizing SBA.
Mm.
So now to the PPP. Well, I forgot about this slide. So just a real quick slide that kind of goes through kind of the high level characteristics of the PPP and the EIDL. The one thing that I really want for everybody to think about and to take notice is the uses of these loans. That's really important if you're going to try to use the EIDL and the PPP loan together. So you can apply for both. We're going to talk about some of the limitations in the EIDL program that at least exist currently. But if you want to use them together, you got to make sure that it's not for the same purpose, right? Mm-hmm. So, and I'll go over that a little bit more in the EIDL, where the EIDL is used for more working capital. That's one of the permitted uses, and that's a really big swath of different expenses. And the PPP loan is meant really to be used on some very specific things, payroll, as we all know, but also rent and debt and utilities. So just make sure that, when you're applying for these or when you're underwriting the loan after the application, that you really think about defining the use of the EIDL loan different than the PPP loan, because there's it absolutely is stated that you can't use them for the same purpose. On our next slide, okay, so here we go, the EIDL. So again, this is a loan that's been around for a long time. This program has been around, 20-something years, and people utilize it in all different sort of disasters. I think that on hindsight, the feds would say nobody ever thought what has happened over the past 3 weeks is what happened, right? They put $50 billion into this loan. They thought this would be great. We'll offer these $2 million loans. We'll base them. They're generally based on the last 6 months of gross profit. Pretty favorable term of 3.75%, a 30-year loan. When we started applying for these, we were like, this is great. We're going to be in this mess for a couple of weeks, for a month. This will give us some working capital in order to get us back up and going. So two things happened. Our 2 weeks turned into 4 weeks. It looks like it'll turn into much more than that, depending on, your geographic location. But in general, I think it's more than anybody ever expected. Secondly, it's our understanding that there's over 3 million applicants, right? So 3 million applicants. So I'm going to do some real quick math for everybody, that if you take 3 million and you times it by $25,000, you get to about 75 billion really quickly. And this program has about 60 billion in it. So in its current funding capacity, I don't think they're going to offer what they're presenting here. Now, the other thing that they did is that in the CARES Act, they opened up another $10,000 per applicant. And when they came out with this, it was too good to be true, right? So they said, hey, look, no matter what, you just sign up for this loan, we're going to give you 10 grand. And so everybody just got on the computer, crashed the system, signed up for the loan, and so they're starting to retract that now. It first came out in a memo out of the Massachusetts SBA office. It's now starting to come out directly from the SBA when you sign up for the loan. But what they're doing is they're giving you that $10,000, and they're saying it's $1,000 per employee up to $10,000 per applicant. Okay. And then the other thing that they're doing is they're stating that they're going to start the disbursements, $15,000 disbursements, that is supposedly to cover 2 months of working capital. And they're going to try to do that sooner than later versus underwriting all of these loans and getting up to this $2 million cap just to try to get money in people's pockets. But again, that's why I kind of referenced the $25,000 at 3 million applicants. We get to 75 billion in like really no time whatsoever. And there's only $60 billion in the fund. What I can tell you is there's a huge effort in Congress right now. We're talking to some of the lobbyists that we talk to regularly, some of the senators and congressmen that we talk to regularly, and they're trying to get more funding for the EIDL program, because they do realize this is a working capital loan. And unlike the PPP, this is hopefully what we're going to use to reopen our restaurant, be prepared to get business back on track.
I have a quick question about that, Tommy. So we have a
Sure.
lot of people who have at this point applied for the PPP, applied for the EIDL, and either
Yep.
they haven't heard back that should they reapply? Should they call their bank, or is it kind of it's just taking a while?
Yeah, it's just taking a while. Again, I think at some point in time in this, I heard that there were up to 1,500 or 1,700 underwriters, right? And again, remember the EIDL is cleared through the SBA, where the PPP we're utilizing the banking system, which is more congruent, I guess, with the normal SBA loans. There's certainly challenges there, but think about the challenges that you've heard about in the PPP program over the past week. Well, you have generally the same amount of people going to the EIDL, and it's a government agency. I mean, this is something that's used to dealing with, a couple of thousand applications at a time, maybe a couple dozen thousand at a time, and it's slowed then. So they're way overwhelmed. I mean, we certainly have called on clients' behalf to try to get some updates, and the answer is we're working on it. I mean, that's really the answer.
And to be clear, these are the three things we've talked about so far, because we have a couple questions coming in. You apply for the PPP through your bank. That's like your bank. You apply through EIDL through a different channel, and you file your ERC tax credits with your actual accountant quarterly. Those are separate things. So applying for EIDL does not automatically apply you for PPP.
That's right. Yeah. So all of them are separate things. So, to say it a little bit differently, so the PPP, you're exactly right on. It's through your bank, right? Or it's through a bank. Sometimes, as we're finding out, it may not be your bank, but it's through a bank. Number two, the EIDL is directly with the SBA. So it is the SBA they're on iteration about 6 of their website right now in their intake form, but it's directly through the SBA. And then the payroll tax credits, you'll find this, a lot of people most people out there today are using a payroll company. So I think that I can tell you for our clients, Meredith and her team, they're doing some of the calculations for people and then getting it to the payroll company. But the payroll company is really who's going to reduce the liabilities associated with payroll taxes based on those credits. So it's the payroll company that's really driving you getting that money, or you not having to pay it out, if that makes more sense.
And one more thing just before we go on, because I know we're about halfway through now. There was a rumor going around that if you filed your EIDL before March 28th, those applications were deleted when the SBA updated their online portal. Do they need to reapply in that case?
So I'm not sure if deleted is, I'm not sure if deleted is the right word, but what they did is, and we certainly were a part of the folks filing prior to that, is we did have to go and reapply. So we reapplied and resent in our information. So I don't know exactly what the mechanic is in the middle, but that certainly was the guidance to reapply. If it makes you feel better or worse, we haven't heard back on those either. So, I think they're still in this big bucket.
So Lana, maybe just reapply again. The person who asked the question.
Yeah. If you filed before, then you certainly need to reapply. That was certainly what they was the guidance. Right. And we're going to kick it over to Jessica, or I guess that's your job, Shira. I'm sorry.
Thank you very much, Tommy, for that. That's very helpful.
Thanks, Tommy. So next up, I want to talk a little bit about the Paycheck Protection Program, or the PPP, and really after I give this brief overview, where I think you guys are going to get a lot of value, is when we talk about the strategy and kind of setting yourself up for success on the PPP. So what this program is really aimed at doing is covering your payroll costs. Now, there's very specific things that this program can be used for, but when we're talking with clients and we're thinking strategy, we're really trying to earmark these funds really exclusively for payroll. And so what you're going to get is you're going to get your average monthly payroll cost times 2.5%. There's a max loan amount, 10 million, and then any portion that isn't forgiven and converts into a note, to your note, 1% interest. There is a 6-month deferral on payments of principal and interest, and then interest is going to accrue on the back end. So at the beginning, I talked about the specificity of these funds. And so when you go to do your payroll cost calculation, there's certain things that are actually built into that when you're doing your average monthly payroll cost. There was a couple of iterations of what is and what isn't included. I think at the beginning, there was some confusion about 1099 contract payments being included, and then it wasn't, as the SBA gave some more clarification. But ultimately, our payroll cost is going to be what drives the actual amount of PPP that we get. As Tommy mentioned, you're actually making that application directly through a bank, and you are submitting your calculation to the bank with your supporting documentation. We've helped a lot of clients with the submission process in terms of getting themselves ready to ultimately submit themselves. And we're seeing, some banks, every bank is asking for a little bit of different information, but ultimately we found it's the same thing. It's how you're calculating your average monthly payroll, the payroll tax forms that, kind of roll into that number, your W-2s, your W-3s. And we've seen the payroll companies actually start to publish PPP calculations on their portals. So if you're using a third-party payroll provider, we are seeing the payroll companies actually kind of start to help with that calculation. Now, you might find that there's a couple of iterations of calculations as the payroll companies have got up to speed with how things are changing, but it does look like there's some resources at your disposal if you haven't already submitted your PPP application. Once you submit, I am seeing on the applications where they're asking you, okay, now tell me how you're going to spend this. Here's the 4 buckets that you can spend these PPP proceeds on. Now you allocate amongst those buckets, how are you going to spend them? And that's really kind of where the work starts on our end and on our client's end is, you are attesting to the bank what you're going to spend the money on, and it can only be spent on those permitted purposes. And so what we're talking with our clients on is, okay, we've applied. Now how do we set ourselves up to make sure that within that 8-week period, so once we get our funds, when the clock starts ticking, how are we going to spend that money in order to either achieve ultimate loan forgiveness, or just in general, how are we going to model out from like a budgetary and a cash flow perspective, how we're going to use those funds and those permissible purposes. So I think that the kicker for the PPP is this forgiveness that so many people are talking about. So ultimately, if you were able to meet the tests that are kind of baked into the PPP, and you're spending 75% on your payroll costs, and then the remaining 25 over the other permissible costs, that there's the opportunity for the loan to be forgiven. So after that 8-week period, you're going to have to go back to the bank and prove to them what you spent your money on. Now, we're ultimately waiting for guidance on what that looks like. We're having our clients set up a separate bank account to receive the PPP funds, and then only spend funds out of that specific bank account for the permissible reasons. We're creating systems where we're monitoring how we're spending. So I think that's where a lot of the work is going to start. And then we also are starting to have conversations, and I think that I've heard this through thought leadership on social media, or from our own clients. This is really great, but I'm not going to be open in 8 weeks. And so what do I do in terms of planning for the forgiveness, or planning to spend the money and knowing that ultimately it's not going to be forgiven? And I think that that's where a lot of the discussions, and Tommy and I were actually earlier this week talking about that very specific question that one of our clients asked us. A large restaurant group, 10 concepts, is PPP right for me if I don't know if in my state I'm going to be able to open up at the same capacity, and I'm going to be able to meet the full-time equivalent tests that are kind of being placed on me. And that is a very real discussion that we're having. And there is no one right answer. I think it's very specific to each restaurateur, each geographic region. rural or, in the city in terms of how you're going to be received when opening the restaurant. And, I think Tommy in the next slide is going to spend some time talking about like what that looks like and how we start to strategize how we're going to use those PPP funds. So I think that this is the part of the conversation I think is really going to impact most of the people.
Yeah, and Jessica, I do have two questions for you. And just to reiterate to the folks listening at home, we have done 2 different seminars on the PPP specifically that get extremely granular. I'd suggest that you go to our website where you signed up for this and rewatch Demystifying Government Support and the critical PPP one that we did last week. We also have some worksheets from that law office that we'll send out with this presentation today. We'll send the worksheet from the PPP specific. And you're definitely going to have a conversation with your own accountants on how this specifically relates to your businesses. 2 questions that did come up that maybe we can give some clarity to broadly is, if you apply for the PPP and you only spend 60% on payroll, does that mean 15% is not forgiven, or does that mean that you didn't fulfill your commitment to the bank?
Yeah, I mean, Tommy, I would weigh in here, but
Yeah,
it does say
I can certainly take that.
Yeah.
So the forgiveness provisions are relatively specific, A, and B, we're still waiting on the regulations for them. So there's really there's 2 main things, I'll say 3, but two main things as it relates to payroll that you've got to take into consideration. And I've actually spent probably the past 10 working hours before we got on here trying to create a spreadsheet, or really trying to create a model that subsequent of receiving your PPP fund, we can go week by week, right? That's how we're going to have to monitor this week by week, especially for our restaurateurs that, all of our employees are gone, or 90%, and then we're going to start bringing them back on. So there's 2 things you need to take into consideration. First of all, it's FTEs, you're going to have to look. There's 2 periods that we're going to look back. One, I think, is February 15th to June 1st. I may have that wrong, maybe June 30th. But our FTE account, so that FTE stands for full-time equivalency. So, so we're going to have to look at, that's going to be our denominator, and our current FTEs, our current average monthly FTEs in this 8-week period is going to be our numerator. So we're going to get, if we don't keep our FTEs at the same levels, right, then we're going to reduce the amount of forgiveness. Okay, so that's number 1. And that's kind of a pro rata. So it's a pro rata basis. So think about it, 50% or 60%, et cetera. The other is actual salaries. And again, in this 8-week period, we're going to look at, so in this case, we go back to what we used for the PPP loan on the front side to look at our average monthly payrolls, right? And then we're going to use average monthly payroll in this 8-week period, okay? And there's a bunch of questions around this. Hey, how do I ramp up? B, what happens? What happens when an employee leaves, an employee goes, et cetera? So I think that the regulations are going to help not only us, but they're going to help the banks give us kind of the forms that's going to give clarity around the calculation. I should just listen to my own advice and stop doing my calculation now, but I can't help myself because what's going to happen is I'm going to end up changing it or changing aspects of it. But those are the 2 things that you need to take into consideration. And then this whole idea of 75-25%, it's not in the law. It was kind of in some regs on the back end. I think it's going to survive. I've been getting a lot of questions of, hey, is this true? Hey, I don't read this in the law. And welcome to Tax Law 101. We start with the law and we use our regs as the Treasury in this case is supplying us with information, and the regs will survive, right? So whatever's written in the regs is generally what we're going to have to abide by, and that's where this is. But how that comes into play and how that factor diminishes our forgiveness is we still don't know. Like we still don't understand like how that happens. So the answer is A, we don't know yet. B, we're waiting for the regs to come out in order to give us clarity on the calculation for us and the banks.
And I think that's something that's so frustrating to everybody, of course, right? And you guys as the professionals who are trying to chase these and who have the most information on what these terms and things mean is that we don't know. And so it's, you want to kind of look at it and play it safe and say, okay, if it says right now 75% for payroll, 25% for rent and utilities, go into it that way and say, I'm going to ask for what I can actually most realistically get forgiven. Some questions that we had is, as folks are listening to the presentation and learning more, if they already applied for the PPP and they're realizing that a different, let's say the tax things that Meredith was talking about, is better for them, can they decline the PPP if they get approved?
So there's going to be an underwriting process, right? This is debt. So what's going to happen is you're going to apply for the underwrite. You're going to apply for the PPP. You're going to do it through your bank. The bankers are going to reach out. They're going to accept your application. They're going to accept your calculation that you provided. And then there's underwriting documents. So yeah, I think at any point in time, if you decide, hey, I'm just not going to sign this, then yes. I mean, then you can go back. I'd have to think about it. I don't know when it's going to make sense to go get a tax credit versus the PPP, because they're giving you money to pay your employees, and the tax credits are giving you money they're giving you a partial payment on the money that came out of your pocket. So I may challenge the math on when it doesn't make sense. But I think there's certainly a time in which you could get less than what you kind of signed up for in a PPP loan, or just forgo it. And the same thing with the EIDL, by the way. There's a loan closing process. This is debt.
Right, absolutely. What could potentially happen to a person if they took a PPP loan and they didn't spend it on payroll?
Well, then they have a loan, So, well, yeah. Well, they have a loan, but I think probably even more importantly there is that when you are signing up for the PPP loan, which a lot of people have had, you are attesting, or you're attesting to what you're going to spend it on. And I alluded to this when we started, and that's really important, because you actually this one set me back a little bit in the early in the SBA application. It said, hey, I'm guaranteeing, or I'm attesting, I don't remember the language exactly, but I'm going to spend it on these things. And if not, I'm subject to fraud. Well,
right.
The three of us and anybody listening, we sign things all the time that say, hey, we materially think this is correct under penalty and perjury. We rarely sign things that say, hey, if I don't use these funds for what I'm telling you that you're permitting, then I'm fraudulent. Like, we don't sign that very often. So again, going back to what Jessica,
clear about that.
Going back to what Jessica said earlier, we're telling our clients to put these in a separate bank account. Make sure that you can trace the funds. Nobody has any idea what the accounting is going to be on there, or the auditing is going to be on the backside of this. We're certainly advising our clients to make sure that they can track these funds and show that they use them for the permitted purpose.
Excellent. And last question, just a final clarification there with forgiveness. Is forgiveness going to be based off of actual salary paid prior to closing, or on full-time employees when they get reopened?
Both. So so the forgiveness is based on the 8-week period and how you spend the money and the FTEs, or the full-time employee equivalent employees, within that 8-week period. So it's not prior to closing. I'm not sure if they're referencing closing in terms of loan closing or closing in terms of restaurant closing, but the 8-week period starts on the day in which you receive the funds and ends 8 weeks to the day later. And the calculation is going to look at how you spent that money during that 8-week period and how many FTEs you have in that 8-week period.
Got it. Okay. Thank you for that. Tommy, I think you have more to share with us before I keep machine gun firing questions at you.
No, fun. And I'm going to try to go over this in 5 minutes, because I think the Q&A is really helpful for everybody. But I wanted to talk about, so we talked a lot about forgiveness, which is kind of the first thing that I have on this slide here. But we're having a lot of conversations, especially, Spehar, you and I were talking before we started here with our New York City clients, that, really taking, not to minimize the brunt on anybody else in the situation, but New York City, I think we can all argue, is really taking a hit here, especially in any of their B2C businesses, where they just may not be back, right? And so we're getting a lot of questions about, hey, I take the PPP loan, can I defer my start date? Which I think currently the answer is no. I think the banks can I think you can defer it about 10 days from the time in which you get the documents from the bank for the time in which the banks will fund it. So I think there's about a 10-day period of some deferment there, but nothing of real significance. But I just want to remind everybody that this is debt. Don't let the carrot define the liquidity here. I think a lot of people are focused on the fact that you can, that there's this forgiveness provision, but the truth is that this is also debt in order to help you fund payroll in order to get back up and going. So in the case that you get a PPP loan and you get it in the next 10 days and nothing is going to happen, you're on full, call it New York City lockdown for the next 8 weeks. This is still liquidity to help you fund payroll in the future. If I didn't think I was coming back, from a restaurateur perspective, and I didn't think I was opening my doors, then I'd have to give myself real pause as if I should be taking the PPP loan. But it is a 2-year note at 1%, and the payments are deferred for at least the first 6 months, and there may be some more relief there. So that's one thing I just want to remind everybody, and that's in concert with the EIDL loan too. We don't have the same kind of timing parameters around the EIDL loan, but this is all hopefully to help you get back on track when your time is to open, and that's going to be different for everybody. It's certainly going to be different than Atlanta, New York, and LA, and Denver, and Nashville, and some of the other places that people are listening to this podcast on. So I think you really have to think about it on your own, from your own perspective. We talked about the rehire employees, the loan forgiveness. Talked about the EIDL, the underwriting process, and update on funding timing for the EIDL. Your guess is as good as mine, and I'm in the thick of it. I'm talking to bankers, I'm talking to some of the lobbyists, and I'm talking to and actually we have some really good lobbyists out of the Georgia Restaurant Association and out of the National Restaurant Association that we're in touch with, talking about trying to push some more money into that fund. And making them realize not only in the restaurant business, but in all businesses, that people really need that money. The other thing that I'm going to remind people of, and we were talking about this earlier about New York restaurants, is that there's going to be more funding out in what we consider the normal realms, right? We're going to see some debt facilities. We're already seeing another $600 billion debt facility for the bigger businesses, for the businesses that couldn't get PPP, they're dubbing it the marketplace funding. That's in the works right now. We're waiting on regs to come out. I've talked to a number of family offices that are looking to invest in the restaurant businesses here in Atlanta and around the Southeast. I expect to have more conversations in the other markets that we serve. One of the great things about the United States is that in crisis, capital finds opportunity. Right. And so there's going to be capital out there. There were a lot of good restaurant groups 6 weeks ago that are going to be great restaurant groups 6 months ago. Right. And the food that you're offering, the way that you brought it, the way that you brought it to the table, your menus, that was all good stuff. And that doesn't take that value out of it. And that doesn't mean that you're not going to be a good restaurateur on the back end. You are. And so there's going to be some capital sources. And I know that my office, we are certainly searching them high and low, and will continue to do so to help our restaurateurs and really all the businesses that Aprio serves, which is a wide swath. But so I just want to remind people that they're going to be there. The capital is going to come in some way, shape, or form, and it may take taking on some debt. It may take giving up some equity. I just want everybody to keep their minds open. We're restaurateurs. I grew up in the restaurant business myself, so I get it. I understand it. But it will come back. And then the other thing that we're really talking about a lot with our clients, and again, this different locales really make a difference here, is what does reopening really look like? I've talked a lot about, not on this podcast, but on others, about having a 13-week cash flow plan and really having this quantitative look of, what you think is going to happen over the next 13 weeks. And that quantitative look, that cash flow analysis is going to continue to move. And if all of a sudden we're sitting in Atlanta, let's say, and we find out, hey, 4 weeks from now, it's back on at some level, right? We're gonna, you know, the lockdown is gone, and people are gonna be out and about, and we're gonna open our restaurant in some way, shape, or form. Well, I'm just gonna delete the columns in the middle and think about and look at what that looks like. Along with that quantitative plan needs to be a qualitative plan. Who am I hiring back? Who's hiring first? What are they doing? You know, that's what we need to be doing right now, in order to make sure that we can reopen. And this equity or this liquidity, we're going to use that in whatever way makes sense, right? So I just want everybody to keep an open mind. You know, we could have a whole webinar series on what your restaurant looks like post-COVID versus pre-COVID, but you're going to have to open your mind from your front door to your kitchen line, to your window, to your back door, and think about what your restaurant looks like post-COVID than pre-COVID. It may look a whole lot different. So that's what we're talking about, and hopefully that's what you're thinking about.
Yeah, fantastic. So we have a lot of questions, and if we have to go just about 10 minutes over, is that okay with you, Tommy?
Yeah, I'm in good shape.
All right, great.
Shape.
So most of these questions focus around sole proprietorship or folks who maybe run a food truck, etc. So there's two questions. When they're calculating their PPP, if you get a W-2, that's very easy. You include that like you would anyone else. If you're living essentially off the profits of the business, can you include yourself in the PPP?
Gotcha. So unfortunately, this answer is not going to make anybody really happy. So here's what's going on. So sole proprietors are a little bit different than partners in a partnership, because this question, the other iteration of this question is, hey, I'm in a restaurant group and it's me and my three buddies and we're partners and this income passes through to us and we don't have W-2. So I'm going to answer both of these a little bit differently, but I think both of them are applicable. So in the sole proprietor, the issue is that the banks really haven't caught up to the fact that sole proprietors have been able to apply for this really from the beginning. And that's different than what I will deem as the self-employed. And that's the partners and the partnerships that I'm speaking of. And the reason is because you go to do the application and you're exactly right. Like, what is my income number, right? And at least on the application, you can put a business name if you're a sole proprietor. In many cases, you can put an FEIN number. But my general thought is that you'd have to look to net self-employment income. And net self-employment income is not something that restaurateurs sit in the back of their kitchen like defining and talking about. I get that. But net self-employment income is that income that comes through, and it's net of self-employment tax. That's what I think that is the base. Okay. What we don't know, and this is for partners and sole props, is we don't know how the forgiveness works, right? Nobody's defined to us, hey, how many FTE calculations do we have? We have one. It's the same person, so that those regs haven't come out. They were supposed to open up for, again, sole proprietors have been able to do this since the beginning. The self-employed were supposed to be able to start doing PPP applications on the 10th. So we thought, gratuitously, like everything else with these set of laws, we thought for sure they're going to release regulations at like 11 o'clock on the 9th, just so that none of us slept. But they didn't, and they're still out. So I've had this conversation with a number of lobbyists. I've had this conversation with a number of restaurant executives that are involved at the National Restaurant Association and some of the state. Everybody realizes this is an issue. I had the conversation with some attorneys that are representing the banks yesterday, because we're speaking with them a lot, understanding the banking side of this. And they said, look, they're not getting any guidance either. And so they're not changing their application process until they get some guidance as it relates to sole prop. So unfortunately, continue to write your congressman, continue to work through your state restaurant associations and the National Restaurant Association. This is a big deal, and I realize there's a lot of ambiguity here, but the answers just don't exist yet.
Absolutely. And we do have Megan Storms from our team auditing this call, so she'll be transferring onto our advocacy platform a lot of the questions that come up here, so that you guys know that goes over to Catherine Miller and Ashley, who deal with a lot of our lobbying and dealing with a lot of the folks on the Hill too. So we'll be working on that as well. Another question that we have is, let's say you get the money, right, and you're going to spend it properly, but restaurateurs and chefs are thrifty. What if they don't spend it all in the 8 weeks? What if they're able to stretch that loan out longer? Is that okay, or is that not okay?
Yeah, so remember, when you get down to the calculation of this, remember that we took payroll cost, or average monthly payroll cost from last year, right? And we times it by 2.5. And so that's really 10 weeks of payroll, right? So if you work that math out, that's 10 weeks of payroll, and we're only actually required to spend 8. So I want to caution people, done correctly, or probably in many cases, you're going to have money left over. Having money left over isn't what drives the forgiveness. It's the spend on the forgiveness. And I think that, probably here, hopefully, we're supposed to have regs on this 30 days after the CARES Act was signed. So whether it's us or somebody else, we'll certainly be doing more webinars on the specifics of the calculation. But remember, it's not about spending all the money. It's just about spending the money in the parameters in which are prescribed by the law. So we expect you to have some money left over. The thing with the PPP, though, is you still attested to what you're going to spend the money on. So you still need to spend it on payroll, rents, mortgage obligations, and other utilities, which in the restaurant business, leaves everything except, really food, food and maybe, CapEx or refinancing any debt. But so I think that you're going to have some money left over. I think it's going to be okay. If for some reason you don't get to spend it in a way that it all gets forgiven, then it just turns into a 2-year 1% note. And so it's going to work like any other note. And hopefully if that happens to a lot of restaurateurs, we'll be able to refinance out of that note into something that's longer term. But again, that's going to, we've got to wait for the credit markets to kind of unfreeze a little bit. And that may be some of the relief provisions down the line as well.
And another clarification on that point, with the 25% going to rent utilities, can 25% be used for interest on other debt or no?
So yes, so two of the things that are defined within the uses of the PPP loan are interest on mortgages and interest on other fixed debt obligations. So think about like an equipment lease, right? Or excuse me, like an equipment purchase, right? That's not a mortgage, because a mortgage is secured by real property, but that may be another fixed debt obligation. One of the weird things in the forgiveness is, while in the permissible use certainly includes fixed debt obligations, but in the forgiveness calculation, it doesn't. So, this is the accountant in us, that really like harp in on what it actually says. We think that may be that may get fixed in the regulations. I don't know that was intentional. We'll find out if that was intentional. So what I mean by that is you can use the money on other fixed debt obligations, but it doesn't go into the forgiveness calculation. So just be aware of that. I think it's another example. I mean, look, the CARES Act and the regulations, were done in haste. I think a lot of people were trying really hard to make this work. There's been numerous examples of where that effort, has had challenges. And I think this is just another example. Hopefully the time that they're using to write the regulations, I guarantee you there's a lot of smart, good people working on those regulations now in the Treasury. The time that they're using, hopefully they'll put the care into making sure it's really clear, so that everybody will have good guidance.
Excellent. Yeah. And with that PPP, the only thing that could potentially be forgiven is if you spent your 75% payroll cost properly. You could potentially have 75% forgiven, or is it the whole thing can be forgiven if it's spent properly?
Yeah, well, the whole thing can. So yeah, so again, I caution people of utilizing the percentages going one way and thinking about the whole loan. It's utilizing them as prescribed. So as long, the best way to think about this is this: if let's say that I had a $100,000 of monthly payroll, right, in 2019. So I got $250,000 worth of debt. I got $250,000 worth of PPP. So as long as I spent 200,000, and let's say I had the same amount of employees and the same amount of payroll, then I'll only spend 200 grand, right? And I'll have an extra 50, right? So think about it in more of that. I think that's a good illustrative example that says if I have the same amount of employees and I have the same amount of payroll, I'm not going to spend the full 250. I'm only going to spend 200 in my example, and then you get full forgiveness of the full 250.
Right.
Does that make
Yes.
hopefully that clears that up a little bit.
Yeah, I think that was very helpful. And with one more question on the 25%. So you can spend it on debt or interest on debt, like you said, the equipment lease or something. Can you prepay expenses with the 25% of funding of non-payroll items, or no? It's not meant to purchase new equipment or new food or stuff like that.
So one of the things that we really want to see in the regulations is how they are going to tabulate our expenses, right? And are they going to do it on a cash basis, or are they going to do it on an accrual basis, or are they going to force us to do it on whatever basis we file tax returns on? And here's what I mean by that. And this comes down to some of the strategies. So in many cases, our restaurant groups have payroll every 2 weeks, right? It's either, every 2 weeks or bi-monthly. And, and so you may have a situation here within that 8-week period that you only have 3 payrolls, depending on how your payroll's set up. So one of the things we're thinking about is, do we go to a weekly payroll, right? Do we go to a weekly payroll in order to get all of those expenses within those 8-week period, right? In order to force as much of that payroll into that 8-week period as possible. It's kind of the same thing with utilities. My utility bill, I get my statement on the 18th. It's not due until the 25th, and my 8-week period, is done on the 21st, right? What we don't know is on an accrual basis, and not to get too accounting-y and nerdy on this, but on an accrual basis, that expense will start on the day that it's due. But if I pay it on the 18th, right, then on a cash basis, that's when the expense hit. So that's part of what we're trying to figure out. We're getting that question a lot. Hey, do I just prepay a bunch of salaries, or do I prepay, a bunch of things? I think it's less about prepaying them and more about doing it on a cash basis versus an accrual basis. And again, I would offer the key takeaway there is if think about your payroll cycle and think about how you could alter that payroll cycle in order to make sure that you're getting all of that into the given period.
Right. And the other thing to re-clarify here is that the PPP loan may not be the sort of silver bullet that we thought we hoped it would be at one point. If you have servers who have been laid off now, or your business is closed, or whatever the case may be, and they're collecting unemployment, and you can't rehire them because they make more on unemployment right now, or they don't want to come back to work for a variety of reasons and they're getting unemployment, they cannot be included in your potential loan because you know that you can't hire them back. Can you hire people back? And what would be the benefit of applying for the PPP, including people in your head count, paying them through the PPP instead of unemployment, let's say if that's an option, and then still not having them come into work? Like, you're still not going to open. Would there be a benefit in doing it that way?
Well, I mean, I think that, a couple of things. So first and foremost, it doesn't have to be the same people. Right. So I think that's pretty important. We get that question a lot. Tim was my server. Do I have to hire Tim back? I don't think so. There isn't anything that tells me that you got to hire Tim. You can hire his buddy Tom.
Right. If you had 10,
so that's number one.
You just have to have 10 again. It doesn't have to be the same.
That's right. So that's number one. Number two, really the benefit here without the carrot, right, is that you can't go get debt anywhere else. Like, so when you are ready to go, when you are ready to go and hire back people and get people back onto your payroll, like, this is liquidity, right? This isn't, I think everybody's focused on the forgiveness and, would say to you, well, if I don't get forgiveness, then, I'm not doing this. Well, good luck getting 1% money anywhere right this second. So this is 2-year 1% money. And that goes back to what I was saying on that last slide is I really try to bring people back to, hey, what are we really doing here? Like, we're really going into debt in order to be able to reopen our restaurant. And if we if the stars align right, and we get to be able to spend that money within that 8-week period in the prescribed ways, we're going to have to pay less of it back. That's all well and good. But to your point, I'm certainly not hiring a bunch of people back for them to do nothing, for me to just, maybe have, that other 2 weeks of payroll at the end for me to lay them off again. That's not good for them, and it's not good for me. So I think the benefit is 2-year 1% money. I think most of us would probably have taken 2-year 1% money before this happened, and I think we'll take it now. So I think that's what we need to keep in mind.
Makes sense. Yes. And to clarify for some folks, and we heard this in a previous one, if you had 2 sous chefs, 5 servers, and 1 executive chef, you don't have to hire those exact people back. You can just come back with 10 servers or 10 chefs. It doesn't have to be the same position either. It's about head count, not job title or salary or any of that. It's about head count.
Yeah. Yeah. And again, I'm going to go back and one of the things we didn't talk about, especially on the executive side, on the chef side, and maybe some of your management executives, depending on how big your restaurant group is that this is capped at $100,000. So you only get credit on the PPP loan side and on the forgiveness side up to $100,000 per employee. And if you had somebody, for instance, that was making $150,000 and you brought them down to 100, you're not getting dinged there. We didn't really get into that, but so it's everything underneath the $100,000. The other thing, to your point and to mine earlier, is have a plan. Like, start putting that plan together. And I think most people, if they're listening to this, if they're following James Beard, if they're following what y'all are doing, I'd be really surprised if they don't have a plan. But I would just get it very specific and make sure it's quantitative and qualitative, and make sure that that, hey, if you get an inkling that this is going to be 4 weeks out, that you have a plan on who you're hiring week 1, week 2, week 3, and week 4. And will you alter that for some of the loan forgiveness? Maybe. But, it may be, it may be that you hire your front end management back because you're going to roll out a new menu. And you may hire your servers back 4 or 5 days ahead of time, even if you can't bring them into the restaurant, so they can study the new menu that you're going to have to roll with, because your old menu doesn't work post COVID,
Right.
And so, that I think that's where the planning comes in. I think the restaurateurs that realize that post COVID isn't pre-COVID, and their restaurant is going to look fundamentally different, down to the food, down to how you deliver the food, and down to how you service your customers, and they have a plan that is on kind of that post-COVID world. I think the restaurateurs that do that the best are the restaurateurs that are going to come out of this. I don't know if it's on top, but they're going to come out better than those that say, you know what, we're going to wait until we can offer the same burgers or the same sushi or the same steaks, and we're going to do it the same way, because I think that's just unrealistic.
Right. Yeah. And that's a lot of folks have questions. I'm going to do 2 more questions about the June 30th deadline. What does that mean?
Yep.
What do they have to have in before then? What do they have to do by then?
So the June 30th deadline is really giving, it's a couple of things, but I think in the context of what I think this question is coming from, it's allowing you to get your FTE count back up, right? In between June 30th. And again, I have some questions too about the June 30th deadline and exactly what it means. Again, I think that we're going to get it. We're going to get some more guidance in the Treasury and the Treasury regulations. But how it's presented currently, it's they're not going to ding you for having your count down as long as you get it up by June 30th on the FTE side. That's how I understand it. But hopefully they're going to give us a little bit more guidance on how we can manage that and how we can manage the forgiveness side.
And for some sole proprietors, unemployment may be a better option for them if they're not working, and if their food truck, let's say, is closed, or their jam factory is, they're doing out of their kitchen is closed. Unemployment may be a better avenue for them to seek, because the freelance thing is no longer an issue. You don't have to be associated, right? That's a little different now, like gig workers, stuff like that.
I'm not an unemployment attorney and don't even play one on TV. So, but what I will tell you about the unemployment insurance part, because I do know some of this, is that they've really expanded what unemployment looks like today versus what it looked like yesterday. And if you were making $120,000 a year and you were a GM or something like that, it's not nearly going to replace your income. It's going to do better than what unemployment used to do. But if you're a server, and probably take out some of the kind of the New York City wage limits, but if you're a server and in a place where you're making $40,000, $50,000, $60,000 a year as a server, then and that can certainly be the case in New York City as well. But it is going to replace the new unemployment amounts, at least for the foreseeable future, are going to replace a pretty good portion of that income. And so, I think that, look, if you don't have any other options, I would put your, I don't know how, I think there's a pride factor here that comes into play a lot of times in people seeking unemployment. But guys and gals, we're in a mess here. So I would put that aside and take advantage of that. That's part of this government stimulus, and that's the federal government, throwing money through the states in order to get you to make sure that you can eat and feed your family. Please don't let pride stop you there. This is everybody's in it together, and everybody's just trying to feed their families and keep themselves afloat. So please take advantage of that. They're trying to streamline the process. It's done at the state level, so every state's different. I think in some cases it's at the locality level, but I really hope that people are taking advantage of that. That's what it's there for, and this is the time to use it.
Yeah, absolutely. Thank you, Tommy. And thank you for the extra 13 minutes as well. It continues to be the topic that we're most talking about. I'm sure that we're going to have you guys back again, maybe even in 2 weeks when things change again. For everyone who had questions about unemployment or about SNAP resources, food access, etc., we did cover those in the last 2 weeks. Go to jamesbeard.org/industry-support-webinars, the same place you went to sign up for this webinar, and check out those resources. If you need the slides from those resources, you can email impact@jamesbeard.org, and we'll make sure that we get those to you. We'll be sending out the slides from today. We know that there are so many questions, and it really is important that you continue to check in with your own accountants on the specific circumstances of what you have going on, weigh all of these different options against each other, and check in with us, of course, and your state resources as to how things are changing and what may be more available to you now than wasn't before. And something you heard 2 weeks ago is probably definitely not true now. And so really keeping an open mind that this is incredibly frustrating for everyone, and we're all trying to just get through it together. And roll with it as best as we possibly can. So I want to thank everyone from Aprio for being here today, and to everyone who joined us on today's webinar. We've got a lot more coming up this week. Tomorrow we have Rachel Sharon talking about motivation in times of crisis. That's both for owners and for folks who are dealing with employees of their community and just wanting to find crisis management strategies. We also are going to talk about seafood. We're going to talk about spirits, and the schedule for next week will be coming out on Friday, where we'll be digging more into the same topics on money management and policy and even some fun things. So thank you again all for being here. You can keep following us here at jamesbeard.org/relief. Thank you to everyone for your insights today, and we will see you all soon. Thank you.
Thank you.